What are the two most accurate or most valued or most used methods for calculating the intrinsic value for a stock? Which ones do you think are the most important? Would you, if you were going to give a weight, if you were going to give weights to these, which ones would you give the most weight, and which one would you give the least weight based on either simplicity, complexity, accuracy, precision? What would be your weight distribution?
Multiple, or this kind of control multiple approach.
Would be the ones you give the most weight to, right? And then you would come up with some kind of weighting scheme for which one's more accurate, the Gordon growth or the perpetuity?
Gordon growth.
Yeah, because it has a growth component to it. So why don't we go ahead, why doesn't somebody come up with some kind of initial weighting scheme? So if you think, if you know that multiple and or DCF is the most important or the most accurate methodology to value a stock, how would you distribute the weights and then give the weights to the other two? You guys are analysts, you would do this. So what would be the weight? What would be your weighting scheme? We're going to do 3 different weighting schemes.
35, 35.
So 35, 35 here?
Yeah.
Okay. So that's 70. How would you distribute amongst the other two?
20, 10,
20, 10?
or 10,
10,
20.
20? Okay. Anybody else? Some people think, the multiple approach, is more important than the DCF. Some people think the DCF is more important than the multiple. It all really depends on who you are and what you value, or what you're trying to do. I can't tell you. You guys are the analysts. You got to go through this stuff. They're going to be asking you these questions. So many questions are going to be asking you the questions. What do you think? What should we do?
30 Gordon growth, multiple
Okay, 30.
Gordon.
30.
Multiple 30.
30.
Then multiple approach 20.
Oh, wait, you said 30.
Yeah,
Is it 30 or 20?
I mean 20.
20. Okay.
That's 50. 30, 20.
What?
On the perpetuity,
Yeah.
probably 30
30.
again,
Okay.
60. And then 20 on the multiple approach.
Well, yeah. So 3, 6, 7, 8.
9, 10, 20. So even.
But why are you giving more to the 2 most simplistic models, and you're giving more weight to the models that are least used by equity analysts for evaluation purposes?
Just a number.
Just throwing it out there?
Yeah.
Okay. Somebody else want to try? Or give it another try?
I would go 10, 20, 30, 40.
10, 20, 30, 40. Okay, that's not a bad distribution. You're giving the least to perpetuity, a little more to Gordon growth, and you're giving the majority of the weights to multiple and DCF. Okay. Anybody else? I got 30 analysts in here with 30 opinions, Your parents tell me you're opinionated, so, when I ask them, it's like, oh yeah, she's very opinionated, so is he. So, give me an opinion.
You could do like 10, 10, 40, 40.
So 10, 10, do you love multiple more than the DCF, or are you fond of DCF more than the multiple? No, just equally,
Equal.
you're tied between the two. So let's go through these scenarios, okay? But let's ask the question right now before I get into the mathematics. Which scenario do you think is the most accurate to calculate the intrinsic value based on what you know about the models? If you were going to pick a scenario based on theory and application, what scenario would you pick as the scenario to use to calculate the intrinsic value? So let's do a vote, okay? How many people think scenario 1 is the best? Okay, 1. How many people think scenario 2 is the best? Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Okay, and how many people think scenario 3? Okay, awesome. You stick to your guns, okay? Because everybody has an opinion. So we're going to use scenario 2, but we're going to go through the calculations so that you can see how to do the calculations. Okay? And you use weighted averages all the time. Okay? You're going to use weighted averages all the time. So we have control. So let's do scenario 1 first. We're going to multiply the intrinsic value. We're going to get rid of this. We're going to calculate the weighted shares. Okay. So 0.1 times $170.63 is
17.
17. Right. Around 6. Got it. Okay. And then what's $195 times 0.2?
39.
Anybody else? You guys should all have your calculators. Click, 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 click. You need to practice on calculating this stuff. Okay, so pull out your calculators. And then $204.75 times 0.35. Again, these are the rates. Right? I have to add it to 100. So $204.75 times 0.35 is 71.66, got it. And then $178.19 times 0.35 is going to give you what?
62.36.
What is it?
62.36.
Got it. Okay, now add these up to give you the intrinsic value under scenario 1.
$190.09.
190.09. That? Is that right? Yes?
Yeah.
Okay. I didn't see you.
Oh.
I'm used to people yelling at me, like, yes, and stuff like that, instead of having read their lips. Okay, so let's do scenario 2. So this should be pretty easy, right? This one's easy, right? We already calculated that. And that one's already calculated too, so we know that. And then 204.75 times 0.3 gives us what?
61.43.
61.43. Awesome. And then $178.19 times 0.4.
71.276.
71.28.
28.
If we add these up, we get the intrinsic value using scenario 2 of
188.77.
188.77. Is that correct?
Yes.
Yeah.
Okay, we got it. So let's do this one. That anymore. And this one's easy, right? We This one's pretty easy too, right? We know it's 1950. Got it. Can we already do this? Nope. So $204.75 times 0.4 gives us what?
81.9.
81.9. And then this one we already calculated here, right, which is 71.28. If we add those all up, what do we get? 189.74. Got it. Excellent. And we're going to use scenario 2 as the weighted average of the methodologies to come up with the intrinsic value to compare against the current stock price to come up with the recommendation in the trades. So we've already done a lot of this stuff. So we're now just reinforcing it and doing the application. And what's the intrinsic value? What did you come up with?
188.77.
188.77, and then what's the current stock price?
Good question.
157.
Is how much?
157.
157. Got it. Is it greater than or equal to? Is it greater than or less than?
Greater.
It's greater than. Got it. And it's going to be trading at a premium. Can you calculate the premium for me? You guys have, no, you can just calculate the percentage change. Or what I usually do, if I know it's a premium, I divide 188.77 divided by 157, and what do you get?
1.202.
1.202.
202. Yeah.
So 20.2% is my premium. Does everybody get that? So if I take 188.77 divided by 157, what do I get? Should get 1.202. Is that right? Right. So do I need to take out the 1 to get the 0.202 to then multiply it by 100 to get 20.2%? Do I need to do all that? No, I don't need to do that. So all I got to do is divide these two, and if it's 1.202, I know it's 20.2%. So I just eliminated two steps. You understand? I don't need to subtract out the 1 and multiply it by 100. If I know it's 1.202, I can just do this. I can almost do this math in my head, right? And if I know it's 1 point whatever, I know whatever the point whatever is, that's going to be 20.2%. So I can eliminate 2 steps and I can get to the percentage in my head really quickly. Okay? So that's just a shortcut to doing percentage changes. Okay? All right, so it's trading at a premium of 20.2%. We're forecasting that the stock price is going to go up by 20.2% within the next 12 to 24 months. Is that possible? Is there a probability that a stock price could go up by 20% within the next 12 to 24 months?
Yes.
Yes. That's
Yeah,
possible.
what if you were getting like 120% point two? A very low probability. So this is easy. And over a 24-month period, that's basically 10.1% per year on average. That's easily doable. Okay, so that's a relative range. So when you guys do these calculations later on, when we start to do the valuations on the bank stock, if you're getting valuations of 30, 40, 50% premiums, you know there's something wrong. You're either too aggressive, or your discount rate's too low, or something's wrong. But if you're getting a premium around 20%, you're in the sweet spot and nobody's going to question you on your research. Okay, great. All right, so then, what would be your recommendation? Ring, hello, proprietary trading unit upstairs. We just did the equity research on one of our stocks. We came up with a target price of $188.77, and we think that the stock price is gonna go up by 20% within the next 12 to 24 months. Our recommendation is to
Buy.
Buy.
buy it.
Bye.
Excellent. Oh, and by the way, the stock, we just valued IBM and Intel. And IBM and Intel make up a significant portion of tech stock price indexes. So our recommendation on the indexes are the following trade. And what would be your trades, your trade recommendations?
Buy on margin.
Well, no, these are on the indexes.
Buy calls.
These are on the indexes.
Buy forward.
Buy forwards,
Buy futures. Buy calls on futures.
buy futures. Buy calls on futures,
Right puts on futures.
exactly. And rate puts. Professor Souza, you're teaching your students, how to trade derivatives? Yeah. It's like, what are they, grad students? No, they're undergraduate students. It's like, you're teaching them that? It's like, yeah. It's like, wow. It's like, yeah, undergrads are just as smart as grad students, so why not teach them the same stuff? How many trades do we have? Four. Got it. Okay. Exchange traded funds. Can we go out and find some tech stock exchange traded funds that have maybe IBM and Intel in it? IBM and Intel make up a significant portion of the market cap of those exchange traded funds. So if we think that Intel and IBM stock prices are going to go up, don't we think that the exchange traded fund prices are going to go up?
Mm-hmm.
Yeah, exactly. So what would be our recommendations to our clients in our proprietary trading units?
Buy on margin.
Actually, let's do the first one first, because we have some clients that don't like the leverage. So the first recommendation would be just to
Buy.
buy it. Got it. Can people just buy the stock?
Yeah.
Yeah. And then what would be the next one?
Buy on margin.
For those who want to leverage? And those who really want to leverage would do what?
Buy calls.
Buy calls. And
Right puts.
right puts. Got it. For how many trades?
3.
3, 4. 4. Oh, yeah. I mean, we could have more ETFs and stuff, but this is just an example. Okay, and what about the stock? What would be your recommendation on the stock? What would be your trades?
Buy.
Buy.
Buy. Margin. What else? What?
Buy calls.
Calls. And then what's the next one? Puts. For how many trades on the stock? And how many total trades?
12.
Got it, okay. All right, that's it. And then it asks you at the bottom, what other stocks are you tracking? So if you're valuing IBM and Intel, what other stocks would you be probably evaluating too? Adobe, Salesforce, all the other tech stocks, right? And then you would be, then you'd probably come up with a bunch of stocks, right? Bunch of stocks, stick them into a portfolio, figure out the weights that you want to be weighted within those stocks, and you'll come up with some expected return on the portfolio. We're not going to do that, that's the investments cost. But, that's what how you would take this information and use it to build a portfolio of securities. Okay? All right. So So what's the next one? What are we doing now? What's the next one? What are we valuing now?
Real estate investment trust.
Yeah, we're gonna value a real estate investment trust security, another share, we're gonna do another valuation. Has anybody ever heard of real estate investment trusts? REITs? These are publicly traded real estate companies. These are not like tech companies. These are publicly traded real estate companies. They basically own, manage, develop real estate assets, commercial real estate, office buildings, industrial, retail, apartment buildings. You know, what was really cool is the Congress in 1960 felt that people like yourself, retirees and investors, should be able to participate in the commercial real estate markets. Because not everybody could buy real estate, you had to have a lot of money. So what they did was they passed the 1960 Real Estate Investment Trust Act that basically stated that real estate companies, if they obtain the majority of their revenue from leasing, managing, buying, building real estate, could circumvent and not pay any corporate income tax if they met that requirement where they got the majority of their revenues from rents on real estate, that they didn't have to pay any corporate income tax. And if they didn't have to pay any corporate income tax, they could pay out more dividends to their shareholders, thereby increasing the dividend yields on their securities, making them extremely attractive for pension funds and retirees, thereby funneling massive amounts of equity capital into the commercial real estate market through these tax preference entities. And the market, when I got into working for the REITs in the mid-1990s, the total market cap was about 40 billion. And currently the market cap is around $1 trillion. Still not as big as other markets or industries or companies, but still they're great investments. They pay constant dividends. They're secured by real estate, and they're just great securities to have in your pocket because they pay quarterly dividends consistently over time and grow those dividends, and the stock price goes up at around the inflation rate or slightly higher over a 10-20-year period. So you can be looking at an 8 to 10% rate of return forever in your portfolio, which means you're going to double your money in less than 10 years. They're kind of nuts. I have a lot of money in them, but it's just a different type of security. So the question is what's the cash flow metric? What was the cash flow metric that we were using to value the technology shares?
Free cash flow.
Yeah, what were we using for the tech securities?
EPS.
Yeah, earnings per share. What are we using for real estate investment trusts? Yeah, funds from operations. It's a free cash flow metric specifically used for valuing REIT securities.
Thank you.
Okay. All right, excellent. So how would we go about calculating the intrinsic value using the perpetuity model for the real estate investment trust?
What is that proposed stand for?
Funds from operations. It's a free cash flow metric, just like EBITDA or EBITDA per share, just like earnings per share. We're using FFO per share to value the security. If we were going to value the company, we would use FFO at the enterprise level. If we're doing the security, we're using FFO per share. Okay. So walk me through how to do the valuation for the REIT using the perpetuity.
Take the FFO per share and times it by the growth rate.
Okay, so what year do we use for the FFO per share? Last year, this year, or next year?
Next year?
Next year. Got it. And then what do we do? I'm just going through the theory right
Then you,
now. How do I get the value using the perpetuity? Then what do we do?
you take that number,
You guys gotta be like thinking about this stuff. You can't just write this stuff down, you're not gonna, you know. The way you learn is agonizing. You're just agonizing to figure this stuff out. That's how you learn. So what do I do with the next year's FFO per share to get the valuation using the perpetuity model? Hopefully, by this time, you're sick of me asking questions like this. Because I've asked it
by
already
the
3 times.
expected return going in.
Got it, so I'm gonna use the expected return. Got it. And then, how do I get the FFO per share for next year?
Take this year's and multiply it by the growth rate.
Got it, so I take $15 per share, and I'm gonna multiply it by what?
8%, 0.08.
Got it. And what's 15 times 1.08? I gotta hear the calculators.
16.2.
What is it?
16.2.
$16.20, got it. And then what do I divide that by?
0.08.
Got it, and what do we get?
202.50.
202.50. Got it. And under the perpetuity model, what's the assumption about the future cash flows?
Constant.
Do they stay flat in the perpetuity or grow at a constant rate? Do they remain flat forever or grow at a constant rate? I can't hear you. Do they stay flat forever or do they grow at a constant rate? What's the assumption? Do they remain flat forever or grow at a constant rate?
Grow.
Okay, do they remain
Perpetuity's
flat
flat.
forever or grow at a constant rate?
Flat.
They remain flat forever. I just keep asking the question until I get the right answer. Right? Okay. All right. I'm not gonna let you off the hook. All right, so what's the next model?
Gordon Road.
Also called constant growth.
Classic growth.
Okay, what's the model? At some point, you gotta take responsibility, right? I can't just sit up here and jibber jabber, right?
FFO per share for next year.
Got it, what is it?
16.2.
Got it, okay, and then what do we do?
We're divided by, expected return,
Which is?
0.08.
Got it.
Terminal, minus terminal.
Do you use the terminal?
No.
Okay, what do you use? What constant growth rate do you use? The going in, which is? Got it. Which gives you what?
0.06.
Got it. And 1620 divided by 0.06 gives you what?
270.
What is it, 270?
Yeah.
Got it. Excellent. Okay, what's the next model?
Multiple approach.
Got it. Excellent. And how do you calculate that? How do you get that?
You take the FFO per share for next year and times it by the multiple.
Got it. So what's the FFO per share for next year?
16.20.
Got it. And do they give us multiples?
Yes.
Yeah, give me the multiples from high to low.
15, 20.
No, from high to low.
25. 22.
25 times.
22 times and 15 times.
Got it. Excellent. And what's 1620 times 25?
405.
Okay. And what's 1620 times 22?
356.4.
356.4, got it. And what's 15 times 1620?
243.
What is it?
243.
Like that?
Yeah.
Okay, got it. And then what's the next approach? To get the intrinsic value? What is it? DCF? Okay, and what are we trying to calculate when we use the DCF? Present value, excellent. What's the first thing we need to know?
How many years?
Yeah, the holding period. And what's the holding period?
5.
And how many cash flow periods do we need?
6.
6. And what do we use the 6 year for?
Terminal.
Terminal value, got it. And what do we do with the terminal value?
Oh, you add it to your file.
Yeah, we're gonna add it to the last year and the holding period. So it's gonna give us the total cash flow in the last year. Okay, got it. So do you wanna do the numerator or the denominator first?
Numerator.
Numerator, okay, what's the first year cash flow?
16 to 20.
Yeah, 1620. Okay, and then how do we get year 2?
Multiply by 1.08.
Times how much?
1.06.
Oh,
6. And what's 1620 times 1.06?
1717
Got it. And then how do we get year 3?
times by 1.04.
Got it. And what's 1717 times 1.04?
1786.
What is it?
1786.
Got it. And then how do I get year 4?
Times that by 1.02.
Got it. And what's 1786 times 1.02?
1821.
18. What is everybody checking the numbers?
Yeah.
Everybody checking them?
1822.
1822? Did you round up?
Maybe the calculator's not.
Yeah, that's okay. I think being off by 1 cent's not gonna, I think both of you guys are right. So how do you get year 5?
Times by 1.01.
1.01, so it's 18.22 times 1.01.
1840.
And then how do we get year 6?
Times that by 1.01.
Got it. And what's 1840 times 1.01? What is it?
1858.
1858, got it. Okay, now what do we do? You want to calculate the terminal value? Okay. So how do we calculate the terminal value? What are we going to use? First things first, are we going to, do we assume that the cash flows are going to remain flat forever or grow at a constant rate? Yeah, growing, because, you know, these office buildings, these things are attached to the ground and they're basically not machines, right? We just pump out cash. Okay. All right, so what model are we going to use to calculate the terminal value? What model are we going to use? Say it. Well, we're not using perpetuity, so we're going to use the Gordon growth model. Okay, got it. So how do we calculate the terminal value from the 6-year cash flow?
You divide it by the terminal, expected return on the terminal FFOPS growth rate.
Yeah, exactly. And what's the terminal discount rate?
0.1.
Yeah, so it's 10%. And then what do they give you as the terminal growth rate?
1%.
1%. And what does that give you?
0.9.
Got it. What's the going in discount rate? What's the going in expected return?
8%.
8%, and what's the terminal? And why is it higher? Why is the terminal discount rate higher than the going in? What's the assumption? Check your notes. Why would the terminal discount rate be higher than the going-in discount rate? What does it reflect?
How many years?
Why would you use the higher discount rate? It's reflecting higher risk in the future. Can you predict the future with 100% accuracy? Nope, so you need to use a higher discount rate. Okay, got it. So what's 1858 divided by 0.09?
205.56.
205.56, got it. Now what do we do?
Sorry, it's 206.4.
What?
206.44.
Okay, what do we do with that?
Add it to your 5.
So we add it to the last year's cash flow. Okay, so it's 1840 plus 206.44.
222.
What is it?
224.84.
224.84. Is this what everybody's getting?
Yeah.
Okay, that's good. Now what do we do?
Do the numerator.
And those are called what? What do we need to calculate now? What are they called? They're called numerators, but this isn't a math class, this is a finance class. So what do we need to calculate now? What do they call?
Future growth rate, or
we
discount
just-
rate?
What is it?
Discount rate.
Well, the discount rate is the expected return.
Is it the factors?
Yeah, we're trying to calculate the discount factors. Okay. We're gonna calculate the discount factors, discount the cash flows, and this count them back to the present to get the present value. Okay, and what's the expected return? What's our going in discount rate?
8%.
8%, so the first factor is what? 1.08. What's the second?
1.08 to the second,
And the third?
1.08 to the third,
The fourth?
1.08 to the fourth.
Okay, and the fifth? Okay, great. Am I driving you guys crazy yet? Yeah, good, perfect. That's how it works. When you start saying to yourself, Jesus, I know this stuff, that's when I know I got you. Okay, so what's the discount factor for the first year?
1.08,
1.08. The second year?
1.17,
1.17. And the third year?
1.26,
1.26. And the fourth year?
1.36,
And the fourth year, the fifth year, sorry.
1.47,
1.47, got it. And what do we do next? What do we do now?
Divide.
I know, I'm trying to get to the specific. You might have to teach this to somebody some days.
1620
So
divided
you're gonna take the
by,
first year cash flow and divide it by the first year discount factor.
yes,
Correct, okay. Got it. So what's 1620 divided by 1? What is it?
15.
15? Is that right?
yeah,
Okay. And then, what do we do now? 1717 divided by 1.17? Is that correct? And what do you get?
14.68,
Okay. And then this one? 1786 divided by 1.26?
14.17.
14.17, got it. And then this one, 1822 divided by 1.36?
13.40,
13.40, and then this one, 1840 divided by 1.47?
152.
no,
I thought you used
you have to add,
the 224.84.
Thought I'd get you. Oh well, next time. So what's 224.84 divided by 1.47?
2.95.
Can somebody verify that?
Yes.
Can you add these up and give me the intrinsic value using the DCF for the REIT security?
That'll work.
Can I do this in Excel?
Yeah.
But don't you need to know how to, don't you know how to do it first before you can program it?
Yeah.
It's 2/10/20.
Like that?
Yes.
Is everybody checking these numbers so we're not going down a rabbit hole? Perfect. So what do we gotta do now? What do we do next? What do we get to do now?
Iterations.
Yeah, we gotta do the scenario analysis, right? The weighted averages. Can you give me the valuations?
202.5.
202.5. And Gordon Road,
270.
270. And the multiple approach,
Uh,
oh shoot, we didn't figure out the multiple approach, did we?
Yeah, we did.
Oh yeah, but we didn't figure out which one we wanted to use. Oh boy, now we gotta go back and figure this out. Okay. Which one do we want to use? Well, let me, in 2014, 2015, the recession, 2008, 9, 10. And then it wasn't until like 11, 12, 13, 14, 15, and there that REIT securities, started to, their share prices started to accelerate because there wasn't a lot of new construction because nobody builds during the recession. And then because of the recovery and the job growth, all this demand started pushing up occupancy rates and caused rental rates to spike in commercial real estate, which caused the REIT security shares to go up significantly because they got multiple expansion. And then after 2015-16, new supply started to come in 2017, 18, 19, new supply came on, job growth started to slow, and the multiples started to fall. Okay, they started to compress. So would you use a 25 times multiple? No. Would you use 22? No. You probably use 15 as the conservative. I mean, when I was teaching the class in 2014-15, we were using 25 and 22. And now we're using 15 because the REIT multiples have come down significantly over the last 2 years. So we're going to use 356 for you. Oh no, sorry, we're using 243. Sorry. I'm starting to lose it. Do you ever feel like that? Just gonna lose it? every day?
Oh, yeah.
I bet you feel you're just ready to lose it on your roommate. I just have a wife and a cat. I just want to lose it on my wife and a cat all the time. So the multiple, we were gonna use, 243, got it. And then the DCF is, 210. Got it, okay, excellent. Okay, so we get to play this little game again. I think we're gonna probably do a better job. I mean, I get some of the scenarios, because we already got two. And everybody's got, I think, a stronger opinion, so they won't be seduced by groupthink within the class. Do people get subjected to groupthink?
Yeah,
all the
they-
time.
Doesn't happen.
Huh?
Doesn't exist.
Huh?
Doesn't exist.
No, oh, no, nobody gets manipulated. Particularly by charismatic people who are very forceful, and they like to speak over you and speak really loud
Oh, yeah.
in the meeting and then embarrass you in front of everybody to get you to do what they want them to do. That never happens. All right, so what is the first scenario? You didn't know I was gonna be a stand-up comic, did you? Really bad stand-up. These have to add up to what? Put the dollar signs in there now. Okay, so what's the first scenario you want to use? We've already gone through the exercise and the debate on what methodologies are, more accurate than others in regards to valuing these securities. So give me the weights.
5,
5%,
15,
15, oh, okay. You must like Gordon growth. Okay, next,
30,
30, and then what's the last
50.
one? 50. I actually kind of like that. Did you use the same one? Oh, no, you didn't, okay. Yeah,
7 or 5,
okay, hold on, let me do it. So 5%,
5,
5%, got it.
1,
20?
yeah,
Really? Okay.
7,
What?
yeah,
Oh, you can't do that.
yeah.
No,
He's the analyst.
you must love DCF. Okay, you, in that scenario, the board may ask you, why are you rating DCF so much more than the other methodologies? And you would say, we feel really confident in our cash flow projections. We did a lot of research and we feel really confident that the DCF method is the best method to arrive at the intrinsic value for this company. As long as you have some kind of logical explanation, then you can do it. But if your explanation is bullshit, it's not going to work. Okay? Or you don't have a good explanation. So what's the third scenario?
5,
Okay, I got 5%,
10,
I got 10%,
40%, and then 45%.
I got 40% and 45%. Okay, awesome. So let's do a, because I don't want to do the calculations and then say, okay, what scenario do you like? Because everybody's going to pick the one with the highest, value, not the one based off of the theory, of what models are the most accurate for these types of investments. So I'm not going to do that. So how many people, of the three, how many people like scenario 1? Okay, 1, 2, 3, 4, 5, 6, 7. Okay, how many people like scenario 2? Why it wasn't me who came up with scenario 2. How many people like scenario 3? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Looks like scenario 3 wins. Awesome. Okay, so what you would do, just remember, when we do this later on in class, you're going to swap these two. Okay? So the scenario that you pick has got to be the one in the middle. Okay? Because that's where my eye's going to go. My eye's not going to go to one side. You accountants know this stuff. It's all about the numbers and where they're placed and how they're formatted, is how you communicate to people. Same thing in finance, and the other disciplines too. So we're gonna use that one. All right, so let's do the calculations. These guys anymore? That guy anymore? And what's 202.50 times 0.05? You can always do this, right? You can always do, what, 2025, which is 10% divided by 2, just cut it in half. You get to the number pretty quickly. Can you do that? That's a pretty easy way to do it. So that's what, 1015, 1013, something like that. And just showing you how to do the math really quickly, because everybody says, I'm not good at math. Well, you know, if you know the shortcuts, it's really easy to get to the answers. So
Can you
what was,
explain that again, please?
yeah, so what I would do, because it's 5%, which
Right.
is really hard to get this, so I would multiply it by 0.1, which is 2025, and then cut it, divide it by 2, which is like 10 point, you know, and so you can get to the numbers really quickly by getting to a number that you already know and then dividing it by, you know, 2 or 3 or 4 or something like that. So, and then sometimes a lot of these percentages that you calculate in your head are close enough, right? You can always go back and calculate it, but that's all you need to know is in your head, and that's why that one over there where you're dividing the current number by the last one and getting the ratio, and you know it's, okay, 1.2 something, well, I know it's 20%. You don't need to know exactly what it is, but you know it's 20%. So you can get to the numbers really quick. Okay, so what's this? 10.13. And then what's 270 times 0.15? 40.5? Thank you. And what's 243 times 0.3? 72.9. And what's 210.20 times 0.5? 105.10. Got it. What you can also do is take the 10%, right, which is 2102, and multiply it by 5. So you can do it that way too, to get to the same number. So the little mathematical shortcuts come in really handy. So if we add this up, what do we get? What's the intrinsic value under the first scenario?
228.63.
228.63. Got it. Excellent. Okay, 0.05, 0.05, 0.2, 0.7. This one we already calculated, right? We don't have to do that. Okay, so 0.05 times 270.
13.5.
2.5, got it. And then 243 times 0.2,
48.6.
yeah, or 20, you know, if I multiply it by 0.1, I get 24.3 times 2, 48.6, and I can get to that way pretty quickly. And what did you say? How much was it?
Oh, 48.6.
Oh, I just said it. Okay, I need cookies. Okay, 210.20 times 0.7.
147.14.
147.14. Actually, I don't need cookies. And then if you add this up, what do you get? I need steak sandwiches.
219.37.
219.37. Excellent. And then under the third scenario, so this one's easy, right? 0.05, 0.1, 0.4, 0.45, we don't need those anymore. Okay. We're almost done. And we'll end it after this. That's easy, right? 10.13, because they're all 0.5s across the top. 0.1, right? We know that that's, 10% of 270 is what? 27 bucks. And what's 4.4 times 243?
97.2.
97.2. Got it. And then 210.20 times the 0.45 gives us what? 94.95? 59, yeah, my dyslexia. Okay, so then add those up and you get the valuation for the third scenario, which is really the second scenario, then we go in the middle. 228.92, got it. Okay. And what was the intrinsic value? 228.92. And what is the okay. What's the stock price?
200.
Is it greater than or less than? Greater than? Can you calculate what the premium is?
14.46.
So if you divide 228.92 divided by 200, what do you get?
1.1446.
1.144, 1.14, 1.15,
So
1.145,
14.46.
1.1, 14.6%.
46.
What is it?
14.46.
45. Let's round up. So we got a premium. We're forecasting the stock price to go up by 14.5% for the next 12 to 24 months. Okay. Is that in a reasonable range?
Yes.
So what would be your recommendation? Okay. Can we find REIT stock indexes to trade derivatives on based off of your research? I can find the NE REIT index, the Dow REIT index, the Vanguard index. I can find all these indexes on REIT securities. So what would be the trades? What else? Futures,
Like calls on features,
calls.
right, puts on features.
How many trades? Got it. Can we also trade REIT stock exchange traded funds? Yeah. So the ETFs. And what would be the trades? Buy. The next one? Margin. Calls. And got it. And then what about the stock? Wouldn't they be the same? So how many trades do we have? What are the trades?
Fine.
What else?
Buy margin,
Margin,
buy calls,
calls,
they write put.
for how many trades? Four. And total trades are,
Well,
okay, that's all I got. I'm done. We'll do the real estate, the real real estate next week. And we're gonna do Salesforce Tower, and then we're gonna do Mission Bay, and then we'll do the investment decision-making matrix, and then we're done. And then you guys don't have to do the last two problems, okay? Those are just problems just to let you see what the accreditation agencies are asking for.
Are those
Accreditation.
extra credit?
Oh, they're extra credit if you want to do them.